Hey, what is going on everybody? Welcome to another video in which we are going to see one of the most popular savings scheme in India, that is PPF, which stands for Public Provident Fund. In this video we are going to see how PPF works, how the interest is calculated and compounded over the years, and also we are going to see some couple of examples for illustration purpose for you guys to make it easy to understand as to how PPF actually works. So let's get started with this video. Okay, so Public Provident Fund is a savings scheme in India that encourages people to deposit or save money for their retirement. Also, it is considered as a tax saving scheme by a majority of the salaried employees due to some reasons that we are going to discuss in the video later. Okay, and it has a maturity period of 15 years, after which you will have two options. Okay, so either you can close your account after the maturity period of 15 years and withdraw all your outstanding balance in your PPF account, or else you can extend your account, okay, for more 5 years. Okay, so after the end of the 15th financial year you can extend your account as well. Okay, and continue it for more 5 years. Okay, and then you can continue until you want it to be, you want your PPF account to be opened. So you can extend it for how many years you want. Okay, but in the block of 5 years. Okay, and two of the most important things about Public Provident Fund is that you can claim tax deductions under ATC. So whatever investments that you have made in the Public Provident Fund in a particular financial year, you can claim the tax deductions under ATC, and also the interest that you earn after the end of the 15th financial year is completely tax free. So whatever interest you earn on your principal amount in the PPF account, it is completely tax free and you need not have to pay any tax. So these are two of the most important facts about Public Provident Fund. Okay, so coming to the account opening part. Okay, you can open the account in any of the nationalized bank or any of the post offices. Okay, and the minimum amount in order to open the account is rupees 100, and in order to keep your account active, that is your PPF account, you are supposed to pay a minimum of 500 rupees per year in order to avoid inactivation. Okay, also a maximum of rupees 1,50,000 you can deposit in a year, which is the ATC deduction limit. Okay, and the deposit can be made in a lump sum or a maximum of 12 installments in a year. So basically these are certain rules as far as the limits of the deposits in the PPF account is concerned. Okay, so coming to the interest rate part, the current interest rate is 7.8% per annum, which is in the quarter two of the financial year 2017 and 18. Okay, so basically the interest rates are subjected to change in every quarter, so that is the reason why, okay, I have mentioned the quarter, okay, and the particular financial year. Okay, also the interest is compounded annually. Okay, so at the end of the financial year it will be added to your principal amount. Okay, so basically compounding is nothing but it's earning interest on already earned interest. Okay, so for starters, okay, let's see one example over here. Okay, so let's say suppose we have rupees 50,000 and we have 8% interest rate. So without compounding it will be 54,000, which is just 8% of the 50,000. Whereas with compounding, that is quarterly compounding, we will get the total outstanding balance as 54,121, which is after compounding annually. Sorry, which is after compounding quarterly. Okay, so that's the power of compounding, or you can say the magic of compounding. And coming to the example part, okay, so let's say you deposit rupees 1 lakh per year for the 15th consecutive financial years, okay, in your PPF account, and assuming that we have 7.8 interest per annum. Okay, so as you can see on the left hand side, we have from the first financial year to the 15th financial year, that is the amount that you have deposited and the interest earned, and then the at the end of each year, okay, the interest is added in the principal amount. So as you can see, it turns out to be a huge amount. Okay, and you have just deposited 15 lakhs in the 15 years. Okay, and it turns out to be 28 lakhs 81,834. That will be your outstanding balance after the 15 years. Okay, and then on the right hand side you can see that 52.05% of your outstanding balance is your deposit that you have made, and 47%, that is 47.95% is the interest that you have earned, okay, compared to your outstanding balance. So that's a huge amount actually, and that is due to the magic of compounding that happens, okay, every year in the PPF account. Okay, so coming to the extension part, you can extend your PPF account. Okay, and this example is without deposit. So if you choose not to deposit for the next 5 financial years after the completion of 15 financial years, you can see that the year-end balance, okay, grows to somewhere around 41 lakhs 95,298. So just the 15 lakhs that you have deposited for the 15 financial years have now grown to 41 lakhs 95,298 rupees in the 20 years. So that's more than double actually. So that's again the magic of compounding in the PPF account. Okay, and let's see one of the most important fact about PPF, that is deposit comparison. Okay, so there's one important fact about PPF, that is if you deposit money in your PPF account before 5th, okay, of a particular month, then you will earn the interest for that particular month, okay, based on the interest rate that is there. Okay, so as you can see on the left hand side, okay, if 25,000 was deposited in the month of July, but it was after the 5th day of the July, then the interest that was earned is 650 rupees. Whereas on the right hand side, if the same amount was deposited before the 5th of July, the interest earned was 813, okay, which is more compared to the previous one. So basically it's always better to be careful as far as depositing the deposit dates are concerned. If you deposit before the 5th day of a particular month, you will gain the interest, okay, for that particular month, or else you will lose the interest, okay, and then you will start gaining the interest from the next month onwards. So this is one of the most important fact that you should keep in mind while depositing in the PPF account. Another important point about PPF account to note over here is that you can avail loan against your PPF account. That is, you can take loan against your PPF at 2% interest rate higher compared to the current PPF interest rate. That is, if the current rate is 7.8% that PPF is providing you, then the loan interest rate would be 9.8%. Okay, and then it can be taken only between the third to the sixth financial year, okay, of the PPF account. Okay, also you will have to repay your loan amount within the next 3 years. Okay, and another important thing about the PPF account is that you can withdraw the amount in your PPF account starting from the 7th financial year. Okay, so it allows you to partially withdraw your from your outstanding balance starting from the 7th financial year. Okay, so that's it in this particular video. Hope you have understood most of the things as far as Public Provident Fund is concerned, and how it works, and how the interest is calculated and compounded over the years. Okay, so if you have any queries, feel free to comment in the comments section. Don't forget to subscribe to this channel, like and share this video. Stay tuned.